It's Sunday, and I'm wrapping up the week by summarizing this week's theme. A financial advisor, me, ranks the worst investments for retirees. If you missed any of the episodes this week, really the main takeaway is there's three criteria that would qualify an investment as something to either proceed with extreme caution or just ignore altogether, just cast it aside. And those three criteria is it's expensive because high fees are always going to be a drag on your returns. There's no way around that. Second, it's risky. But what really bothers me, and I think we need to be really cautious about, is that there are lots of investments that are risky, but they're wrapped in this veil of safety. And so if you see something, especially if it has a really high income stream, but it seems safe, that should send off little alarm bells in your head. And then the third one is it's illiquid. Can you sell it easily when you want to and get a good price for it? A lot of investments that I don't like that I talked about this week, they are highly illiquid, meaning you can't just turn around and sell them easily. Or if you do need to sell it, you're going to take a massive haircut. There's no secondary market. There's nobody out there looking to buy these. And so you have to sell it at a fire sale price, which obviously we want to avoid. So specific investments that I talked about that I do not like, the one that I think is probably most controversial that I'm going to get some hate emails about is residential investment properties, rentals, duplexes, vacation rentals, rental house, things like that. The returns on them are not that great. And the headache factor is massive. I also talked about annuities. Now, this is a huge category, and annuities, like most other investments, they are appropriate for some people. But I would say like 80% of people, maybe higher, that have an annuity. I'm like, you don't need an annuity. This is not something that is an appropriate investment for you. So what makes them so hated is they tend to be expensive. So that checks the one box. They're generally not risky at all, actually. So that one's fine. But they're very illiquid. Like you can't sell them within like 7 years in most cases without taking a huge significant haircut. And they just come with super high fees. They tend not to pay off in the long run. And they're oversold by commission salespeople who make a big fat commission check when they sell them to you. I also was talking about high yield bonds, actually high yield anything, and why that's problematic. I talked about structured notes, which I've seen a lot more prevalence of in recent years. Just in the last couple of years, I see a lot more of these than I used to. And I think that's problematic. They're also very expensive, highly illiquid, and I don't know why they're, I do know why they're popular, because commission-based advisors get a big fat commission. Are we seeing a pattern here? Okay, then lastly, I talked about private investments. So this is another huge category. It encompasses hedge funds and any investment in like private businesses, maybe like a particular real estate fund where you're pooling money from several different investors to buy a real estate investment. Could be venture capital. If you think like Shark Tank, you're the Shark Tank people investing in the business that's coming to you, asking for an investment, and they're going to give you something in return. So you're not buying a publicly traded company, one that is readily available. It's a private investment because each deal is very unique. Each deal is structured differently, and they tend to be highly illiquid. In certain cases, very expensive. You know, hedge funds have big fees and they take profits first. They also tend to be pretty risky. The data shows over a long period of time, even though, you hear stories constantly about someone turning $100,000 investment into a little tiny business, one day becoming a billionaire. Yes, that does happen. But generally, for you and for me and pretty much most other investors who consider these funds, the returns just don't justify the risk and the illiquidity. All right, so that's about it for this week. I think the takeaway is that the more you know about some of the criteria, and if you establish some principles, like I'm not going to buy things that have high fees, I'm not going to buy things that are risky, I'm not going to buy things that are illiquid, it'll help you to judge whether an investment. That's my personal criteria. I think it works pretty well. Tomorrow, I'm starting a brand new theme, the Widow or Widower's Financial Roadmap. What do you do when a spouse dies, especially when that spouse managed the finances, made most or even all of the money decisions? It's a very difficult time filled with grief. And the last thing we want to do is to throw on financial problems on top of that. How do I pay my bills? What do I do just in the first month, 2 months, 6 months after a spouse dies? There's a lot of financial changes that happen. And if you go through all of those things in your head, it's difficult to think through those in advance. But it could be as simple as paying the credit card bill, getting access to the accounts. There might be changes with Social Security and pension where you have to send the death certificate so that those changes can be made. You want to make sure that the spouse knows where all the investment accounts are and how to get money from those accounts if and when they need to. So there's a lot of steps to consider in preparing a surviving spouse to pick up the financial pieces after a death of a spouse, especially when the other spouse who passed is the one who made most or all of the money decisions and handled all of the finances. I hope you have a blessed Sunday. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.